So we're going to go over some basic stuff. A mortgage is what you have when you buy a house. It is the document that secures the note. So the note is the promise to pay, and the mortgage is the document that gets recorded that creates a lien on your property. So with every note, the promise to pay, you have an interest rate. Every note will have an interest rate. There are two types of interest rates out there. One is the fixed rate, and then there's an adjustable rate. And there's many reasons why you would use one or the other. The other thing we're going to talk about is the different types of mortgages. Every loan or program that's out there is either going to be a conventional or a government loan. Those two. Then there's different categories for those. The biggest difference between conventional versus FHA is that conventional interest rates are based on your credit score. So if you have a lower credit score, you're going to have a higher rate. Opposite with FHA, FHA pretty much just has a standard interest rate no matter what your score is. So your more credit challenged or lower credit score people would go FHA. It's not a bad thing. It's a great loan. It's a government loan, but it does allow people that don't have excellent credit or they have maybe a little bit credit challenged people to be able to buy a house as well. So that's good news. The other big difference between FHA and conventional is the PMI. PMI stands for Private Mortgage Insurance. That is an add-on to your payment. The only way to avoid the PMI is if you put 20% down. So that's an add-on to your monthly payment. Again, the PMI on conventional is based on your credit score, whereas with FHA, it's a lower PMI and it is not based on your credit score. The PMI, Private Mortgage Insurance add-on to your monthly payment, is only required while you have over 80% loan to value. What that means is when you have 20% equity and the balance on your mortgage is 80% or less, you can get rid of the PMI. Good news is if you have a conventional loan, you can get rid of the PMI without having to refinance out of the loan. Refinancing can cost you closing costs, or if the rates are higher, you may not be able to refinance. It may not make sense. So FHA, you have to refinance out of an FHA loan in order to get rid of the PMI. Pros and cons for both, right? There are other programs out there, such as USDA. USDA is a conventional loan, but that is for rural areas. The USDA loan is a zero down program, so that's wonderful. And the PMI on there is very minimal compared to FHA or conventional. But again, it's only in rural areas. There's also what we call jumbo loans. Jumbo loans are for loans above $726,000. So the conventional max on a loan is $726,000, and the jumbo would be anything above that. The other type of loan that we have out there that's very common is a VA loan. That stands for Veterans Administration. That is for our military people. We love to take care of them, and we love that, you know, what they do for our country. This is how they get paid back. They get to do what's called a VA loan, which does not require PMI. That is the only loan out there that does not have any PMI. And they can do 100% financing. So as you can see, there's many different options out there. There are many more depending on your situation. So never feel like you have to fit inside the box. There's many options, many programs, many different things. Those are just a few, and those are the most popular ones. Okay, so let's go a little bit further into detail about fixed versus adjustable. So a fixed rate means that for the term of your loan, which could be a 15-year, 20-year, or 30-year, the rate is fixed at all times. It never fluctuates. It never goes up. It never goes down. So your principal and interest payment will remain the same. The adjustable typically will start at a lower rate than the fixed rate, and it adjusts after 5 years. So it's fixed for the first 5 years, and then it'll adjust every 6 months after that. There is a cap, meaning that it can't go above 2% every year or 5% over the lifetime of the loan. The reason that somebody would do an adjustable is because the rates are higher at the time, and it gets them into a lower rate, but the plan is to refinance within those 5 years that adjustable is fixed. So they don't start adjusting right away. Like I said, it takes about 5 years. And so, guys, one is not better than the other on the adjustable versus fixed. It just depends where the market is, what your needs are. A lot of stuff goes into play there. So if you know for sure that you're going to be out of your house in 2 to 5 years, adjustable would make sense. If you're the type of person that doesn't move around, Fixed makes sense. So it just depends on your personal needs and goals. Feel free to give us a call if you have any questions. We'd love to educate you more on mortgage lending.